often look for a quick policy change, a new president, or a secret market shortcut to suddenly build their net worth. But the richest people usually pick a specific path and work it relentlessly for a decade. When you look at the top of the Forbes billionaire list, you see the household names in tech who raised massive amounts of venture capital. Most of these famous founders built their empires through traditional methods, either by raising outside money or funding the growth entirely from their own early sales. But if you scroll just past that top tier, a huge concentration of global wealth belongs to people's names you probably don't know. They don't build standard software or consumer goods companies. They manage funds. Understanding how these individuals operate shows that the highest levels of wealth often come from stepping away from day-to-day operations and learning to structure capital itself. This fourth path is straightforward. You use other people's money to buy other people's businesses. Let's look closely at the actual math of how this powerful leverage works in practice to generate wealth. A manager might write a relatively small check for $5 million, and within 7 years walk away with a personal profit of $90 million or more. The question is how someone legally commands that return without actually running the businesses they own. Breaking down the mechanics of a private equity fund reveals exactly how millionaires cross the threshold to become billionaires. A fund requires two main participants, the general partner, who actively manages the deals, and the limited partners, who supply the majority of the cash. This chart shows how a typical $100 million fund is structured. The general partner puts in about 5%, or $5 million, while the limited partners provide the remaining $95 million. They take that initial $100 million and use it as equity to secure $200 million in debt. Now they have $300 million in total purchasing power to buy companies. Over the next 5 to 7 years, the general partner works to improve those acquired businesses, aiming for an annualized return of about 20%. If they hit that 20% target over 6 years, that initial $300 million portfolio grows to roughly $900 million. Stacking outside investor capital with heavy commercial debt creates a growth trajectory that normal business operations simply cannot match. When it's time to sell the portfolio and collect the profits, the money is distributed through a strict sequence known as the waterfall. This chart illustrates the payout order. First, you have to repay the lenders. That means returning the original $200 million loan, plus an estimated $100 million in interest. Next, you return the limited partners their initial $95 million, along with a guaranteed minimum return, usually around 6 to 8%, which takes another $40 million or so off the table. What's left is about $465 million in pure profit. Depending on the contract, the general partner splits the remaining pool with the investors, often taking anywhere from 10 to 50% of that upside. By leveraging both investor capital and debt, a general partner turns a $5 million entry ticket into tens of millions in personal profit. Given those numbers, it raises the question of why anyone would choose to build a standard business from scratch. Bootstrapping allows you to keep all of your equity, but without outside cash, growth is slow, and you often lack the funds to hire top-tier leadership or build advanced technical systems. Raising venture capital solves the cash problem. However, it dilutes your ownership, introduces board members who can vote you out, and forces you to swing for a massive exit, which leaves most founders with nothing if the company fails. You could choose passive investing, buying shares of public companies or real estate. Warren Buffett is famous for this, but he started as a child and achieved his massive wealth by living into his 90s. It takes decades of compounding and requires a high income to fund the investments in the first place. Every traditional method requires a heavy sacrifice in speed, control, or timeline. Fund management sidesteps those bottlenecks by acquiring established cash flows at scale. While the financial mechanics look perfect on paper, the day-to-day reality of running a private equity fund carries an immense psychological weight. As a general partner, you are entirely beholden to the limited partners who expect constant returns, tightly monitored by federal regulators, and reliant on the operational founders who actually run your acquired companies. You also face agonizingly long feedback loops. A single poor acquisition might not reveal its true cost for 5 to 10 years. You trade the freedom of running your own small company for the permanent, high-stakes responsibility of managing portfolios. You cannot start your career by raising a massive fund. Attempting this without deep operational experience is a fast track to losing everyone's money. Investors will only hand over tens of millions of dollars if you have a proven track record of business success, a distinct market advantage, and access to deals that no one else can find. You need proprietary deal flow. For example, a fund dedicated entirely to harvesting and selling black walnut trees over a 30-year cycle. They have the highly specific relationships and niche expertise that standard investors completely lack. There is plenty of capital sitting idle in the market. What investors lack are highly credible, risk-mitigated opportunities. That requires a natural progression. You start by bootstrapping a business, learn to invest the excess profits, and only move to managing outside capital once your skills are undeniable. Taking a seat at the highest level of finance takes patience. You have to spend years mastering the mechanics of business before you earn the right to command the math.